Welcome back. If you are just joining now, pause for a moment and focus, because what is unfolding across the markets right now is not random price action, and it is not driven by retail fear. This move did not happen by accident. It was signaled in advance, it was timed deliberately, and it unfolded exactly the way large institutional participants operate when liquidity events are approaching. We had already highlighted that markets were exposed heading into this week, originally anticipating that pressure would emerge closer to the Bank of Japan's interest rate decision. Instead, the sell-off arrived early on Monday morning, and it arrived aggressively. That alone should make it clear this was not emotional behavior, it was positioning. Here is the key detail most people overlook. Markets do not wait for headlines to react, they move ahead of them. By the time the majority of participants are watching the announcement, the bulk of the adjustment has often already occurred. That is precisely what happened here. Market makers and large players understood what was coming, understood how liquidity would respond, and acted before the broader crowd had time to adjust. Orders that had been placed in advance began filling immediately, which is how you know this was not reactive selling, it was planned execution. Now let's address the argument that always surfaces during moments like this. It was already priced in. That phrase is constantly misused, and most of the time it is applied incorrectly. Discussion does not equal pricing. Something becomes priced in only when positioning changes, not when opinions are formed. What we witnessed today was positioning finally adjusting at scale. That is the difference. The market did not shrug this off. Risk was repriced aggressively. There is also historical context that cannot be ignored. The last several times Japan raised interest rates, Bitcoin dropped more than 20% shortly afterward. That pattern is not superstition. It is liquidity mechanics. Japan sits at the center of one of the most critical funding channels in global markets. When that channel tightens, risk assets feel it, and crypto feels it first. Ignoring that history does not make it irrelevant. What makes this move especially significant is how it unfolded. Within minutes, billions of dollars worth of Bitcoin were sold across major exchanges. That does not happen accidentally. Retail participants do not move markets like that. Selling of that magnitude requires deep liquidity access, algorithmic execution, and pre-positioned intent. This was driven by market makers, not by people waking up and panic selling. This ties into a broader issue crypto has been dealing with since late last year. Several large market makers were severely impacted during previous liquidation events and have been forced into extended unwind processes. When large players are trapped on the wrong side of leverage, they cannot exit immediately. Doing so would destroy their own books. Instead, they unwind gradually, applying consistent selling pressure over weeks or even months. That creates a heavy market where rallies fail and downside feels persistent. This is why price action since October has felt different. It is not just sentiment, it is forced selling colliding with thinning liquidity. When you combine that with a macro catalyst like a Bank of Japan rate adjustment, you get sharp, uncomfortable moves that feel unfair if you are not prepared for them. But this is the part many people struggle with emotionally. These moves feel painful, but they are not inherently bearish over the long term. They are cleansing events. They expose weak positioning, excessive leverage, and speculative excess that built up during easier conditions. Markets cannot sustain higher prices without flushing that excess first. Every major bull market in history was preceded by a phase that felt exactly like this. The problem is that most participants experience these phases emotionally instead of structurally. They see red candles and assume the thesis is broken. They forget that short-term price is not a measure of value. It is a reflection of liquidity and positioning. When liquidity is pulled, price becomes indifferent to narratives. This is where patience separates outcomes. Large players do not panic during these events. They prepare. They place orders ahead of time. They wait for liquidity to come to them. They understand that coordinated sell-offs create opportunity because they force weaker hands out of the market. None of this implies the pain ends immediately. Liquidity events do not resolve in a single session. They unfold over time. But understanding why the move occurred is the first step to navigating it correctly. Without that understanding, people react emotionally. With it, they can think in probabilities rather than panic. To truly understand why this unfolded the way it did, You have to step outside the crypto bubble and look at the funding layer beneath global markets. This is not about social media narratives or headlines. It is about where capital originates and how changes in interest rates ripple through every risk asset. One country more than most people realize sits at the center of this process: Japan. For decades, Japan operated with ultra-low interest rates, while the rest of the world cycled through tightening and easing. Japan remained near zero. That created one of the most powerful liquidity engines in modern finance. Institutions could borrow yen at minimal cost, convert it into other currencies, and deploy it into higher-yielding assets. Stocks, bonds, real estate, and eventually crypto benefited from this flow. This was not a niche strategy. It became structural. Trillions of dollars were deployed globally through this mechanism. As long as Japanese rates remained anchored near zero and returns elsewhere were higher, liquidity flowed outward, risk appetite expanded, and leverage quietly accumulated. The critical point most retail investors miss is that cheap money does not just lift safe assets, it pushes capital further out on the risk curve. Risk-taking increases not because investors are reckless, but because the funding environment rewards it. That is how valuations stretch and speculative excess forms. But the entire structure depends on Japan remaining the cheapest place to borrow. Once that condition changes, the math breaks. That is what is happening now. Japan is raising rates to defend its currency and manage inflation, while other central banks are pausing or preparing to ease. That compresses the interest rate differential that made the carry trade attractive. When that spread narrows, borrowing costs rise and returns diminish. Institutions are forced to reduce exposure, not because they turn bearish, but because balance sheets and risk models demand it. Liquidity that once flowed freely begins to retreat. Liquidity does not disappear instantly. It unwinds gradually, then accelerates as feedback loops engage. Large players reduce positions methodically, but even controlled selling suppresses upside and increases volatility. Crypto reacts faster than traditional markets because it is thinner and more leveraged. When capital needs to be raised quickly, crypto becomes a primary source. It trades around the clock and responds immediately to funding shifts. This is why crypto appears to overreact when it is actually reflecting changes before other markets fully process them. This is also why the idea that something was already priced in fails in practice. Awareness does not equal positioning. Markets can discuss an event for weeks and still move violently once capital adjusts. What we saw was not a response to news, it was a response to funding, conditions shifting beneath the surface. Timing also matters. Liquidity shifts do not follow clean calendars. Institutions front-run these events because they must. By the time decisions are announced, repositioning is already underway. That is why moves like this catch people off guard despite being widely anticipated. This is not isolated to one asset or narrative. It is a global funding adjustment moving through the system. Crypto is simply the most sensitive gauge. Understanding that does not remove volatility, but it provides context. This is not chaos. It is mechanics. When liquidity tightens, crypto magnifies stress because it is faster and more leverage sensitive. Institutions sell what is liquid and accessible. Crypto becomes a funding source. Fundamentals do not shield price in the short term. Liquidity-driven sell-offs do not discriminate. Correlations spike. Everything trades as risk. XRP exists inside that system. It is not broken. It is participating in a deleveraging environment. Support levels fail because forced selling overwhelms balance. Liquidity unwinds often grind rather than crash. Pressure builds, releases, then returns. This process transfers assets from emotional participants to disciplined ones. For XRP holders, separating timeframes is essential. Short-term weakness driven by liquidity does not invalidate long-term relevance. Confusing mechanics with failure leads to poor decisions. Markets reward patience after leverage is flushed. Every cycle follows the same rhythm. Deleveraging first, stabilization next, reaccumulation quietly, expansion later. This phase punishes excess, not viability. Institutional capital becomes selective. XRP sits closer to infrastructure than pure speculation. Opportunity appears when selling pressure exhausts itself, not when headlines improve. Liquidity resets take time. Most people disengage during this phase. That is when positioning quietly occurs. This is not a random crash or a failure of crypto. It is a liquidity-driven reset unfolding, as these systems always do. Coordinated selling reflects repositioning, not panic. For XRP holders, perspective matters. Short-term weakness does not negate long-term structure. This phase rewards preparation, not prediction. Markets overshoot during stress. Narratives flip, discipline matters. Deleveraging comes first, expansion comes last. None of this removes risk, but it reframes volatility. Everything discussed here is educational only and not financial advice. Markets involve risk and responsibility rests with the individual. Discipline, not emotion, is what survives every cycle.